What if your money never loses value? A dollar saved in 1950 buys the same loaf of bread in 2025. Economic crises last weeks, not years. Banks quietly fell without dragging entire nations down with them. This isn't fantasy. This is the world we walked away from on December 23, 1913. While most Americans prepared for Christmas that day, President Woodrow Wilson signed the Federal Reserve Act. The promise was simple: stabilize the economy, prevent banking panics, protect the American dollar. A century later, the dollar has lost 98% of its purchasing power. We've endured humanity's worst economic depression. Financial crises became not an anomaly, but an inevitability. The question isn't whether the Fed succeeded. The question is, what if it never existed? The United States has no central bank, hasn't had one since Andrew Jackson destroyed the second bank in 1836, calling it a tool of aristocracy and corruption. For 7 decades, America operates under what economists now call free banking. Private banks issue currency backed by gold and silver. Market forces regulate credit. Bankruptcies happen, but they don't become national catastrophes. October 1907, panic strikes. The Knickerbocker Trust Company collapses. Fear spreads through New York's financial district like wildfire. Depositors rush to withdraw their money. Banks unable to meet the sudden demand for cash begin to fail. The stock market crashes nearly 50%. The economy contracts. This is the panic of 1907, the crisis that would justify creating a central bank for decades to come. But here's what the textbooks rarely emphasize. The crisis resolved itself in weeks, not years. No government bailouts. No printing trillions in new currency. No sacrificing the dollar's value. J.P. Morgan, America's most powerful banker, locked competing financiers in his library until they agreed to pool resources and save the system. Private clearinghouses issued emergency currency. Prudent banks absorbed the reckless ones. By early 1908, the crisis was over. The economy resumed growing. Now compare that to what happened after the Federal Reserve's creation. The 1929 crash didn't trigger a weeks-long panic, it sparked a decade-long Great Depression. Unemployment hit 25%. Industrial production collapsed by nearly half. Thousands of banks failed. The Fed didn't just fail to prevent catastrophe, it created the conditions that made it inevitable, then failed to stop the cascading collapse. The mechanism was straightforward. Throughout the 1920s, the Federal Reserve kept interest rates artificially low, flooding the economy with cheap credit. This wasn't the natural market rate determined by supply and demand for capital. This was a politically determined rate, set by committee. Businesses borrowed aggressively to expand. Stock speculators took out loans to buy on margin. Real estate developers borrowed to build. The economy boomed, but this boom was built on sand-on money created from nothing, on credit that didn't represent real savings. When reality returned, when the Fed finally raised rates in 1928, the artificial boom became a very real bust. But instead of allowing bad investments to clear quickly, letting failed enterprises restructure or liquidate, letting resources reallocate to productive uses, the Fed made everything worse. They contracted the money supply by a third between 1929 and 1933. Banks desperately needing liquidity found none. Businesses desperately needing credit got nothing. A crisis that could have been sharp but short became prolonged and devastating. Now imagine the alternative. Picture 1920s America with no Federal Reserve. Without a central bank artificially suppressing interest rates, the credit boom never happens. Banks operating on their own reserves, without the promise of a lender of last resort, remain conservative. They can't lend money they don't have. They can't create credit from thin air. Speculation still occurs, of course, but it's limited by the actual availability of capital. When the inevitable recession arrives, and economic cycles always exist, it unfolds like previous 19th century downturns. Sharp, painful, but brief. Resources reallocate quickly. Businesses that made bad bets fail. Businesses that planned wisely survive and expand. Workers move from dying industries to growing ones. The entire painful process takes months, maybe a year or two, not a decade. No breadlines stretching for blocks. No Dust Bowl families migrating west in desperation. No global rise of totalitarian ideologies fed by economic despair. No World War II born from the ashes of economic collapse. This isn't speculation. This is pattern recognition. Before 1913, the United States regularly experienced recessions. The data shows them clearly. Sharp drops in economic activity lasting an average of 12 to 18 months. Then recovery, then growth. The panics of 1873, 1884, 1893, 1907, though painful, were self-correcting. Markets cleared, prices adjusted, life went on. After 1913, the pattern changed. Recessions became deeper and longer. The Great Depression lasted over a decade. The stagflation of the 1970s, caused by the Fed's monetary expansion to finance the Vietnam War and Great Society programs, dragged on for nearly a decade. Recovery from the 2008 financial crisis took longer than any recovery in American history. The boom-bust cycle didn't disappear with the Federal Reserve. It intensified. Let's look closely at the 2008 crisis because it perfectly illustrates the problem of central banking. For years after the 2000 dot-com crash, the Fed under Alan Greenspan kept interest rates at historic lows. 1%. Money became practically free. The entire economy restructured around this cheap credit. Banks borrowed aggressively and leveraged those loans 30, 40, even 50 to 1. Hedge funds used complex derivatives to amplify their bets. Home buyers who couldn't afford houses suddenly could, because adjustable rate mortgages started with rates too good to be true. Wall Street created increasingly exotic financial instruments, mortgage-backed securities, collateralized debt obligations, synthetic CDOs, credit default swaps. These weren't answers to natural market demand. These were answers to an ocean of cheap credit that needed somewhere to go. The housing bubble inflated, not because Americans suddenly needed more homes, but because the Fed made money so cheap that speculation became more profitable than production. When the bubble burst and all bubbles burst, the response was predictable. The Fed and Treasury Department declared the system too fragile to allow failures. Banks that gambled recklessly got trillions in bailouts. AIG, which sold insurance on toxic mortgage securities without the capital to back those promises, received nearly $200 billion in government support. The executives who created the disaster kept their bonuses. Homeowners who took mortgages they couldn't afford lost their homes. Taxpayers who had nothing to do with any part of the deal paid for everything. Now imagine the alternative again. Picture the early 2000s with no Federal Reserve. Interest rates aren't set by a committee in Washington. They're determined by the market, the real supply and demand for capital. When the dot-com bubble bursts, no one artificially lowers rates to cushion the blow. Banks remain cautious. Lending standards stay tight. The housing bubble never inflates because the cheap money that would fuel it doesn't exist. Some financial institutions still make bad bets. That's the nature of markets. But without the moral hazard created by implicit government guarantees, without the expectation of bailouts, these institutions fail quickly and quietly. Other banks that were prudent acquire their assets at fire sale prices. Depositors might lose some money, which focuses their attention on choosing stable banks rather than chasing the highest interest rates. The crisis passes in months, not years. No tent cities. No millions of foreclosed homes. No European debt crisis cascading across borders from bank failures. History gives us real examples of this alternative model. Take 18th and early 19th century Scotland. The Scottish banking system operated with minimal government interference. Banks issued their own currencies. Competition was fierce. There was no central bank for bailouts when things went wrong. The result? One of the most stable banking systems in the world. Bank failures were rare. When they occurred, they didn't become systemic crises. The Scottish economy thrived. Or take a more recent example, Iceland in 2008. When the global financial crisis hit, Iceland's 3 largest banks collapsed. These banks had assets worth 10 times the country's GDP. The Icelandic government faced a choice: bail out the banks or let them fail. Unlike the United States, unlike the European Union, Iceland chose to let them fail. The banks went into receivership. Top executives faced criminal prosecution. Some went to jail. Foreign creditors lost money. The currency collapsed. The predictions were apocalyptic. Iceland would become an economic wasteland. Recovery would take decades. The choice to let banks fail would become a cautionary tale. The opposite happened. By allowing bad investments to clear, refusing to burden taxpayers with banking debts, and prosecuting fraud, Iceland recovered faster than any other developed nation hit by the crisis. Within 5 years, the economy was growing again. Unemployment fell. The currency stabilized. Iceland's choice confirmed what free market economists had been arguing for decades. The fastest way through a crisis is through it, not around it. This brings us to perhaps the Fed's most insidious effect: inflation, the slow, steady erosion of the dollar's purchasing power. Between 1800 and 1913, prices in the United States remained remarkably stable. Yes, there were fluctuations. Wars caused temporary inflation. Panics caused temporary deflation. But measured across decades, a dollar in 1913 bought roughly the same basket of goods as a dollar in 1800. More than a century of money holding its value. Since 1913, the dollar has lost 98% of its purchasing power. What cost $1 in 1913 costs over $30 today. This isn't a natural phenomenon. This isn't an inevitable result of economic progress. This is the direct consequence of the Fed's ability to create money from nothing, to increase the money supply without a corresponding increase in goods and services. The mechanism is deceptively simple. When the government wants to spend more than it collects in taxes, it issues bonds. The Federal Reserve buys these bonds not with existing money, but with money it creates electronically. The government spends this new money. It enters the economy. More money chasing the same amount of goods means prices rise. This is inflation. And it's not a mysterious force of nature. It's a deliberate policy choice. Now picture a world without this mechanism. Imagine the United States still on the gold standard, or operating with competing private currencies, or any system where money can't be created at the whim of central planners. Government spending is limited by tax revenue and the willingness of private investors to buy bonds at market rates. Deficits can't be financed by printing money. Politicians face real constraints on their ability to spend. What happens to prices in this world? They follow the 19th century pattern. When productivity grows, when technology makes goods cheaper to produce, prices fall. This isn't economic catastrophe. This is prosperity. Your wages might stay the same, but you can afford more each year because goods become less expensive. Saving money makes sense because the money you save will buy more in the future, not less. The entire economy reorients toward capital accumulation and long-term thinking rather than consumption and debt. The counter-argument is always the same. We need the Fed to smooth business cycles, respond to crises, manage the economy. But this assumes that central planners can make better decisions than millions of people making decisions based on their own knowledge and circumstances. It assumes that a committee in Washington can set the right interest rate for an economy of 300 million people making billions of transactions. It assumes that politicians and bureaucrats have both the knowledge and the incentives to prioritize long-term stability over short-term political gain. The evidence says otherwise. Every major financial crisis of the past century has roots in Federal Reserve policy. The Great Depression followed the credit expansion of the 1920s. The 1970s stagflation followed monetary expansion to finance the Vietnam War. The save-in and loan crisis of the 1980s followed interest rate manipulations. The dot-com bubble followed the Fed's response to the 1998 long-term capital management crisis. The 2008 financial crisis followed post-2000 rate cuts. Each crisis is met with the same response: more intervention, more money creation, more attempts to engineer outcomes. Each response creates the conditions for the next crisis. How would American economic history look without these crises? Start with the 1920s. Without the Fed-fueled credit boom, the decade is still prosperous, but the prosperity is built on real productivity gains. Electrification, assembly line production, rising education levels. The stock market grows, but based on genuine earnings growth rather than speculation with borrowed money. When the inevitable downturn arrives around 1930, because economies develop cyclically, it's sharp but short. Unemployment spikes perhaps to 10% for 6 months, then falls as businesses adjust. No prolonged depression, no New Deal. No massive expansion of federal power. No precedent for government intervention in every aspect of economic life. Without the Great Depression, the political landscape of the 1930s looks completely different. Economic despair doesn't fuel the rise of extremism in Europe. Hitler doesn't come to power in Germany, not devastated by the economic aftermath of an American financial crisis. Mussolini's Italy doesn't become a model for authoritarianism. The Soviet Union doesn't look like a viable alternative to failed capitalism. World War II, if it happens at all, occurs for different reasons and takes a different form. Fast forward to the 1960s and 70s. Without the Federal Reserve monetizing government debt, Great Society programs and the Vietnam War face real budget constraints. Politicians can't promise unlimited spending because they can't print money to pay for it. They must choose between guns and butter, between war and welfare. The discipline of sound money forces hard choices. Inflation doesn't devastate savings. Wages don't lose purchasing power. Workers don't need to demand higher wages just to stay in place. The economic turbulence of the 1970s simply doesn't happen. The 1980s and 90s look different too. Without previous decades of intervention creating distortions, there's no savings and loan crisis to resolve. No need for massive deregulation to fix problems created by regulation. The economic boom of the 1990s, driven by genuine technological revolution in computers and communications, isn't amplified by a monetary bubble. When the tech sector matures and growth slows, there's no dramatic crash, just normal adjustment as capital reallocates from one sector to others. This brings us to the present day. Without the 2008 crisis, without the subsequent decade of near-zero interest rates and quantitative easing, what does the 2020s economy look like? Housing is more affordable because there was no bubble to inflate prices. Retirement savings weren't destroyed by crisis after crisis. Inequality is lower because monetary expansion, which primarily benefits those closest to money creation, didn't channel trillions into the financial sector. The economy is more stable because it's not built on a foundation of ever-growing debt. Think about what this means for individual lives. You're born in 1950 in this alternative reality. Your parents' savings, accumulated through years of work, hold their value. They can actually retire on what they saved. You enter the job market in 1970. Your wages aren't eroded by inflation. When you save 10% of your income, that money grows in real terms, not just nominal. You can plan for the future with confidence because money is a stable store of value. You buy a house in 1980. Because there were no credit-fueled housing bubbles, prices are reasonable relative to incomes. You take a modest mortgage at a market rate reflecting real supply and demand for capital. You pay it off in 15 years, not 30. By 1995, you own your home outright. You continue saving. You invest in productive businesses, not financial speculation. By retirement in 2010, you have genuine wealth, not a portfolio that could collapse in the next crisis. Your children born in the 1980s face better prospects than in our reality. College is more affordable because decades of government-subsidized loans didn't inflate costs. They graduate without crushing debt. They can afford to start families earlier because housing and cost of living are lower. They can take entrepreneurial risks because they're not buried under debt payments. The economy they inherit is more stable, more prosperous, more oriented toward production than consumption, toward saving than borrowing. But the benefits extend beyond individual prosperity. Think about innovation. In an economy without central banking distortions, capital flows to the most productive uses. Investors can't rely on bailouts or cheap money from the Fed. They must genuinely assess risk and reward. This means fewer resources wasted on speculation and financial engineering, more resources devoted to genuine innovation and productivity improvements. The tech revolution still happens, but healthier. Companies build sustainable business models rather than chasing growth at any cost, financed by venture capital awash in Fed cheap money. There's no crypto bubble born from distrust of central bank manipulation of money. It's not needed because money already functions as a stable store of value. Financial innovation focuses on genuinely improving efficiency and reducing risk rather than creating complex instruments to profit from instability and amplify it. Consider the international economy. The dollar, because it holds its value, remains the global reserve currency not through inertia and military might, but through genuine preference. Other countries want to hold dollars because dollars maintain purchasing power. International trade isn't distorted by currency manipulation and competitive devaluation. Emerging markets aren't devastated by sudden flows of hot money seeking yield in a zero-rate environment. Global capital allocation is more efficient because prices provide accurate signals. The geopolitical consequences ripple outward. American foreign policy operates under tighter budget constraints. Without the ability to finance military operations by printing money, interventions require genuine public support and willingness to pay. The military-industrial complex doesn't inflate to its current size. Resources that would have gone to foreign adventures instead build domestic prosperity. American influence in the world rests more on economic dynamism and less on military power. This isn't claiming a world without the Federal Reserve would be perfect. Markets still develop cyclically. Businesses still fail. People still make mistakes. Recessions still happen. But the nature of economic pain changes. Instead of prolonged grinding crises that destroy lives and break spirits, downturns are sharp but short. Instead of unemployment lasting years, adjustment happens quickly. Instead of entire generations scarred by economic trauma, people experience setbacks as temporary rather than existential. In our reality, economic insecurity is pervasive. People worry about the next crisis, the next recession, the next collapse. They've lived through it repeatedly. They've seen their parents' savings evaporate, their neighbours' homes seized, their own career prospects destroyed by forces beyond their control. This breeds cynicism, anxiety, political extremism. People stop believing in markets, in institutions, in the future itself. In the alternative reality, economic confidence is higher. Yes, bad things happen. Yes, there are downturns. But they're manageable. They pass. People trust that hard work and prudent planning will be rewarded, that their savings will hold value, that opportunities will emerge. This breeds optimism, resilience, social cohesion. Politics is less divisive because economic anxiety doesn't fuel extremism on both left and right. The banking sector itself operates differently. Without deposit insurance backed by the Federal Reserve's ability to create unlimited money, banks can't rely on government guarantees. Depositors pay attention to bank stability. Banks compete on safety as much as returns. The result is a more conservative, more stable financial system. Yes, banks sometimes fail, but they fail individually, not systemically. Their failure doesn't threaten the entire economy. This changes the relationship between Wall Street and Main Street. Without the implicit bailout guarantee, without cheap money fueling financial speculation, banking returns to its core function, taking deposits and making loans to productive enterprises. The financial sector doesn't inflate to consume 8% of GDP and earn 40% of corporate profits. Finance serves the economy, not the economy serving finance. Think about the cultural implications. Without constant inflation, without boom-bust cycles caused by monetary manipulation, the culture of debt changes. Borrowing becomes associated with significant purchases like homes rather than everyday consumption. Credit card debt doesn't balloon because people aren't constantly trying to maintain living standards in the face of eroding purchasing power. The social pathologies associated with consumer debt culture simply don't develop to the same degree. Wealth inequality follows a different trajectory. In our reality, monetary expansion disproportionately benefits those closest to money creation, the financial sector, asset owners, the already wealthy. This is called the Cantillon effect. New money enters the economy at specific points and benefits those who receive it first, before prices adjust. Without this mechanism, wealth still accumulates through talent, luck, and inheritance, but the artificial amplification through monetary policy doesn't occur. The question arises, if this alternative reality is so much better, why did we get the Federal Reserve? Why did smart people in 1913 create an institution that would cause so much harm? The answer lies in the seductive appeal of control, the hubris of expertise, the political convenience of hidden taxation through inflation. The architects of the Federal Reserve genuinely believed they could improve on market outcomes. They looked at the panic of 1907 and saw not a self-correcting crisis, but a failure requiring technocratic solution. They believed that with the right tools and the right experts, they could smooth business cycles, prevent crises, optimize economic outcomes. They couldn't imagine that the very attempt to control the economy would create distortions worse than the problems they sought to solve. Politicians supported the Federal Reserve for different reasons. A central bank offered a way to finance government spending without the politically painful act of raising taxes. They could fund popular programs, wage wars, expand government, all financed by money creation. The costs inflation and financial instability would come later, after the election, perhaps under a different administration. The benefits were immediate and visible. The costs were diffuse and easily blamed on other factors. Bankers supported the Federal Reserve because it offered protection from failure. Rather than bearing the full consequences of risky decisions, they could rely on a lender of last resort. They could leverage their capital more aggressively, pursue riskier strategies, grow larger, knowing that if things went wrong, the Fed would step in. The promise of bailouts, even if implicit, fundamentally changed their incentives. So the Federal Reserve was created not because it was the optimal solution to real problems, but because it served the interests of those with political power. The consequences boom-bust cycles, the Great Depression, the 2008 crisis, the erosion of the dollar were invisible in 1913. These were theoretical concerns raised by critics who were dismissed as cranks or extremists. Only in hindsight, only by comparing what happened with what could have been, do we see the full cost of the choice made that December day. This thought experiment isn't purely academic. It has implications for today. The Federal Reserve continues conducting the same policies that created previous crises. Interest rates remain historically low. The money supply has exploded. Government debt has reached levels that would have been considered impossible decades ago, entirely enabled by the Fed's willingness to buy bonds. Asset bubbles inflate in stocks, real estate, cryptocurrencies, everywhere cheap money flows. The question facing us now isn't whether to undo 1913, we can't. But we can ask whether it makes sense to double down on the same policies, whether more intervention will solve problems created by intervention, whether monetary expansion can continue indefinitely without consequences, whether a committee of economists can successfully manage an economy of 330 million people better than markets. The alternative exists not just in imagination but in practice. Cryptocurrency, whatever its flaws, represents an attempt to create money that can't be inflated at will. Gold continues holding value precisely because governments can't create more of it. Some countries experiment with currency competition, allowing people to choose what money they want to use. These aren't perfect solutions, but they represent recognition that the current system has deep problems. The path not taken in 1913 remains visible if we look for it. It appears in every crisis that resolves quickly when allowed to clear naturally. It appears in the success of economies that maintain sound money policies. It appears in the failure of every attempt at central planning to produce better results than free markets. The evidence has accumulated for over a century. The question is whether we'll finally learn from it. Picture once more that world without the Federal Reserve. Not as utopia, not as perfection, but as an economy that works with human nature rather than against it. where prices signal genuine information about scarcity and value, where saving is rewarded, not punished, where banks prosper by serving customers, not gaming bailouts, where economic cycles are short and painful rather than long and devastating, where money serves as a tool for prosperity rather than a tool for control. That world was possible. In some sense, it existed for most of American history before 1913. It could exist again if we made different choices. The Federal Reserve isn't an inevitable feature of modern economies. It's a policy choice. And like all choices, it has alternatives. The question isn't whether we can imagine a better system. The question is whether we have the courage to build it. The lesson of this alternative history is simple but profound. Sometimes the best intervention is no intervention. Sometimes the wisest policy is letting markets work. Sometimes attempting to control complex systems creates more problems than it solves. The Federal Reserve was created to prevent crises. Instead, it created conditions for the worst crises in American history. It was created to stabilize money. Instead, it destroyed the dollar's value. It was created to serve the public interest. Instead, it served the interest of politicians who want to spend without limits and bankers who want to profit without risk. We can't undo 1913. We can't remake the choices of those who came before us, but we can learn from them. We can acknowledge that the path we chose led to repeated catastrophe. We can acknowledge that the promises of central banking went unfulfilled. We can imagine, and perhaps even build, something better. The alternative reality, the world without the Federal Reserve, shows us what we lost. It also shows us what might still be possible if we're willing to question institutions that have failed us and imagine something different. This isn't nostalgia for a past that never was. This is recognition that the principles underlying free banking, sound money, and market discipline produce better results than central planning, monetary manipulation, and bailout culture. The evidence spans centuries and continents. The logic is compelling. The question is whether we'll act on it or continue down the path we've travelled for over a century, hoping for different results from the same policies that have repeatedly failed. The world without the Federal Reserve wasn't perfect, but it was better. More stable, more prosperous, more free. That world is still possible. All it requires is the courage to admit we made a mistake and the wisdom to choose differently. History didn't end in 1913. It continues today. Every decision about monetary policy, every bailout, every round of quantitative easing is a choice to continue down the same path or finally change course. Generations of Americans have lived with the consequences of a choice made over a century ago, a choice that seemed reasonable at the time but led to catastrophe after catastrophe, a choice based on the belief that experts could manage the economy better than free people making free choices. That belief proved false, again and again, but acknowledging this requires more than just intellectual honesty. It requires willingness to surrender the illusion of control, willingness to trust decentralized processes that no one controls but that work better than any plan, willingness to accept the short-term pain of clearing crises instead of the long-term disaster of suppressed corrections. The alternative history we've explored isn't just an academic exercise. It's a mirror showing us who we could have been, the economy we could have had, the prosperity we lost. And most importantly, it's a roadmap of where we can still go if we find the courage. Every great crisis offers a moment for reassessment, a moment to ask whether the institutions we trust truly serve us, whether the policies we follow actually work, whether the path we're on leads where we want to go. We live in such a moment now. Debt is higher than ever. Monetary expansion is greater than ever. Distortions are deeper than ever. The next crisis is inevitable. The only questions are when and how bad. When it comes, we'll have a choice. The same choice we've made again and again. More of the same or something different. More intervention or more freedom. More control or more trust. More manipulation or more honesty. The history you've just seen shows where each path leads. One path we know. We've lived with it for a century. We've seen its results. The other path, the one not taken, still waits. The only question is whether we'll finally be brave enough to take it.